Ted Oakley, managing partner and founder of Oxbow Advisors, joins us today. With more than 40 years of experience in advising high net worth clients in the investment industry, Ted implements the firm's proprietary investment strategies and the Oxbow principles to provide a unique investment perspective. He's a frequent guest on Fox Business News, Bloomberg Radio, Kitco News, Cheddar TV, Yahoo Finance, and many, many more. And we are thrilled to have Ted join us once again today. It's time to saddle up and silver up for Ted Oakley. Ted, welcome back to SBTV. How are you doing?
I'm doing great, Patrick. Thank you.
Thanks for coming back on, Ted. Really do appreciate it. Ted, I got to start with the Ukraine. Russia has crossed its neighbors' borders, and we're seeing the markets continue to run red for some days now, actually. And I'd just like to know, what are your thoughts on what's happening right now?
Well, Patrick, this is a little different than most. I mean, it's more like, really more like the Kuwait invasion and George Bush Sr. when they caught it. Really, people thought they probably wouldn't go into Kuwait, and they did. And obviously, it had some impact on the market at that time. It was over quickly. I think this is a little different in that I know I was in this camp that I would have been surprised that he went in because they're already in a recession in Russia, and really was wondering why that would go that way. But I think in a lot of ways there were some problems on both sides if you really look at it clearly, and that's not that I'm backing Russia or anything. I just think there's some things that could have been done to make that a little bit better. But being said, that is. We're probably now in a situation where you're going to, at least for some time, have a global slowdown of some number because people will just start to pull in. They'll say, hey, I don't know what's happening, so I'll just pull in. And it comes at an interesting time because we felt like that things were rolling over anyway. We felt like housing was rolling over. We could see some things going on in the economy that made us feel like that the second quarter would be not negative, but not near as strong as people thought. So that all coming together at the same time puts you in a situation like today where the market's down big, and not a day that, if you haven't sold before today, it's hard to chase it on the way down. I mean, we've been really defensive. But I think that's what you're into right now. And I also think there's a lot of people that are not ready for this because they haven't been around market and bear markets and things, true bear markets where they just go down, stay down, maybe semi-crash on you, that kind of thing. So that's where we are. I would say for people, if you don't have any liquidity, you might want to have some. We have quite a bit actually, but we didn't foresee this coming. We just thought the second quarter, we thought that it was going to get worse and worse in the marketplace. But I'm sorry to go on so long, but that's the way I see it right now.
Those are some great points there. And you touched on something where the markets, investors, I mean, they've seen wars before. But I really wanted to ask, is this one a bit different? Is it different this time considering that superpowers could be involved?
Patrick, that's a really good point because if you look at it, you now have a consortium really sort of between Russia and to a degree China where, two superpowers that don't necessarily care for the U.S. I wouldn't say it's total adversarial, but I mean, I think that's where you could say. And so that's a little different than what we've seen. Where I was coming from on the investor side is we have this whole set of investors that have only been around 12 or 13 years, and they've never seen anything bad. They've never seen rates go up. They've never seen a war. Nothing has really ever affected them other than the COVID deal in 2020. But even that, the Fed came in and saved everybody. So if you go into a prolonged period of slower economic growth, down markets, or markets, I always tell everybody that if you have a really, really speculative market, it's not going to correct by going sideways. They don't do that. They go down. Now, if you're lower already, you can go sideways. But when you're in a really speculative market like we've been the last 3 years, when they correct, they go down. So we'll see where it takes us now.
Yeah. On the flip side, something that's been going up is oil. It's at around $100 per barrel. Ted, how significant a role is oil going to play in the Fed's attempt to raise interest rates?
Well, I think, Patrick, it would be hard for them to hang their hat on one thing. It'll be interesting today. There's 4 or 5 Fed people talking today and tomorrow and giving speeches. Be interesting to see if they back off a little bit and are not quite as hawkish as they were. I noticed in the futures market already they backed off a half a point increase down to everybody thinks it's just a quarter now after today. So I think they have to go ahead. I think they're backed into a corner. They have to do something in March. We've said all along that we thought they could only do 1 or maybe 2 before they blew the thing up. And we're still pretty much on that. But the Fed will be watching it for sure because the only thing they really care about is the stock market when you get right down to it, unfortunately. But I think they have to go through with it with March because they're already there. After that, we'll see. If we get really, really weak, I'm talking about markets in the second quarter, you could see them pivot. But I think you've got to go deeper before they pivot.
Right. Because I think it's pretty well known that the Fed needs about 4 to 5% percentage points to be able to drop whenever they go into a recession. Are we going to get anywhere near that 4 to 5%? And should this conflict drag on? I mean, as you mentioned, 1 or 2 rate hikes. Really, the Fed has nowhere to go?
Well, that's a good point, Patrick. I think you said it right. The problem about the 4 or 5% is I don't think they can ever get there. If you were today, where you were to raise Fed funds to 4% or 5% today, it would blow up so many things. We have so much debt in the country, not only government debt, but we have debt everywhere. Individuals, corporations, you name it, private equity. So I don't think they could ever get there without just really ruining things because our growth rate is really slow, immigration's really slow. There's a lot of things demographically that don't work here. So I think they can't do that. I think that'd be hard for them, but they could go back. You know, what could happen is they could raise rates once, maybe twice, and then have to go all the way back to zero again if it didn't work. We'll see. But and unfortunately, that would just cause one more round of inflation in the next year. So they're in a tough spot.
You know, Ted, let's say the Fed has to stop course. They have to stop raising rates. They have to make a U-turn and come back down to 0.25% or come back to zero. Are we looking at QE again? Are we looking at bond purchasing again?
Well, I would say, Patrick, you know, they're at a quarter now. It's really interesting about this rate thing. You know, if somebody was going to play the rate move, they should have already played it because it's already in the pricing. So by the time they get to a half or 3/4, whatever's going to happen's already happened. But to answer your question, yes, they would have to go all the way back to a quarter or zero, and then do some purchasing, which that's unfortunate. But they've leaned so hard on the stock market that they are in a position where the markets would have to be down and stay down for a while, I think, for them to do it. But that's you're right about that. It's the only thing they could do, really. So we would just have to see.
And again, should the Fed do this, how then do the markets and the global economies see this?
Well, I think people are not understanding that if you look at most of the large economies, okay, Japan, for example, if you look at what's going on, they've run this debt to GDP up so high, government debt, that when you're in that sort of thing, your growth rate keeps going lower and lower and lower. So you don't get movement in pricing. And I think what would throw people the next 5 years is that your growth rate would be low. I mean, and see, prior to the last 3 or 4 years, what happened is you know, let's say that you had 70% growth in the S&P earnings and maybe 30% multiple expansion on the PE. Well, we've reversed it the last 2 years or 3 years because of the Fed. We have 70% expansion on the PE and only 30% growth, which means that you're going to shrink that PE multiple, that growth side. It's going to stay the same maybe or go down, but the PE side is going to shrink. And when it does, that's where you get into marketplace. And I think that's where you are right now.
If you're enjoying this interview with Ted Oakley from Oxbow Advisors and I, please consider subscribing to our YouTube channel and giving us the thumbs up to let the algos know you want more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. And speaking of purchasing, the 2 and the 10-year had some 50 basis points between them, then some 40 basis points. I think now we're down to 35 basis points between the two. Are you seeing a flattening of the yield curve and perhaps even an inversion of the yield curve in the short to midterm time frame?
Well, I did. I'd say this morning it's a little different. Not a lot, I might add it. And by the way, in two of our income strategies, in just yesterday and then a few weeks before, we had bought the 20 and 30-year Treasury because our thought process by flattening the curve, the long end's going down and the short end's going up, which is what's been happening. Now, today, you have a big move down in rates on the 20 and 30 year because people are scared. But we still think that's sort of in place, and we're looking for those 20 and 30 year bonds to do better, we think, than the short term. So you could see that to get an inversion at this point, if this war keeps on going on, that might change that. They may say, well, we're going to do this one, and we're just going to look at it. And then you wouldn't really get a total inversion. You'd just be a flat curve. But the flip side of that is people would be so worried about what's going on that they wouldn't be doing a lot anyway. And that's where you are today, I think.
Okay. Ted, in your expert opinion, how in general is America's economy doing? And I ask this because to a non-expert like me, I think the Fed is reacting too slow, too late to the markets and the conditions, and then they jawbone, they see the market reactions, and then they huddle up and decide which play to run next. I mean, this kind of tells me the markets are extremely fragile and sensitive. But in your opinion, how is the economy really doing?
Well, Patrick, I think you're right about the Fed. I mean, if people invest based on what the Fed says, then they need to get out of the business. Because I've watched the Fed, and I've always said this, but the only Fed president that I ever believed was Paul Volcker. From then on, it didn't make any difference, and I still think they're always late. You don't know what they're going to say. You've got nothing against educated PhDs, but that's what they have at the Fed, and they don't really know what's happening in the real world. So that's the problem you have. Where that ends up affecting us in the economy is this. You can be slowing and things can be happening week to week for the average worker, and they have no idea about it because they're all up there in the one building and they don't know what's going on, on Main Street or on your street in your neighborhood. And what's happening now is they've driven this inflation side so high that people are starting to choke now, and you're starting to see it in a lot of things where they say, "Hey, I can't do that." So I think what happens is the economy, you mentioned the word there, fragile. I think that is a really great description of where the economy is right now for a number of reasons. But the number one reason is because if you look at what drives the economy, that 70% of people that consume, that consumption has to go lower for a number of reasons. One, they're not getting any money from the federal government. Two, the Fed's not pushing anything out there to help them on the investment side. And three, on the real estate side, residential real estate and that kind of thing, is just burying these people. And you can see it now. You just look at mortgage applications are started down fairly strong, and refi activity is down over 50%. They're killing that market. And I looked yesterday, the 30-year was 427. A year ago it was 282. That's a big change for a payment. And then you had real estate pricing go up 20%. So all of a sudden, you're taking that consumer that drives the economy now, okay? You're pressing them down, and that's why you're going to see that show up, we think, slower growth in the second quarter and probably the third.
Yeah, that's a great point, Ted. With what you see today, the overvaluations of companies, the markets, the cryptomania, the Fed interjection in the markets, are the 2020s sort of like the 1920s reborn?
I don't think so, Patrick. I think to a degree, maybe up until 21, you maybe could have said that, but what happened, and what did happen in the 20s, if you remember, was that Weimar Germany had a tremendous amount of inflation early on, and that's what really allowed the door open for Hitler to really show up and say, we're going to take it back like it was, make you feel good, whatever. And anyway, that was part of what happened. I think for us, we're more in a position like coming off of the late 30s or the early 40s, where we had this rounds of inflation. They had the rates too low during the war, not too low, but I mean they had to have them really, really low, and then they had to work out a way to come out of that between 1945 and 1960. And what happened was they kept the rates low and let inflation go up, and the dollar and your buying power really, really went down. We feel like you're more in that type of atmosphere, and then all of a sudden, how would that affect stock prices? Probably take the returns of the last 5 years, which is spoil people, by the way, and going into the future, they may not get a third of that. They may not even get that. Maybe they get 4 or 5% total. But that would throw off a lot of people right now.
Okay. Hey, Ted, what are you looking at down the road ahead? Are we seeing inflation still, stagflation, disinflation, or deflation?
Well, we came off the 7.5% year, Patrick, and I would guess that inflation wouldn't not go away. I mean, but when I say we don't look for as much inflation, if we have 3 to 4% inflation, that's a lot compared to where it was between, say, in the last 3 to 5 years. That's quite a bit, taking out 21. If you just go the 4 or 5 years before that, we were averaging 2.25. So if you're up at 3.5 or 4, you're still inflating more than you normally would be. And we would expect that to be that way. People don't realize, but once you get into April and May, you're going to be comparing against a base last year that had already started up. And so it goes something like this. I've had 10% inflation. I go from 100 to 110. The next year, if I go up to, say, 115, my inflation rate actually went down because I only went up 5 points. Now, you're still 15 points higher than you were 2 years ago. Don't get me wrong. But that's why people misread the CPI number, because once you start comparing to a higher number, which we get into high numbers April, May, June, and so it won't be as high, probably 4, 3.5, 4 maybe or something, but it's there.
Yeah, it's definitely there. Ted, what are some of the fears and concerns your investors or clients tell you?
Well, I think a lot of concerns for investors. If you look at where the money is today, is held. It's not really held in people under 40 years old. There is some there, don't get me wrong. But most of the money today is held by people that are over 55, and in many cases over 60. And so they look at that and think, what if something drastic really happened? AKA, say, Ukraine. And we go into this devastating downturn or whatever, and I'm sitting here having to live off of this the next 20 years or 25 years. And that's one of their number one concerns right now. Number two concern is just making some money, because a lot of these people have had liquidity events. We work with a lot of business owners after they sell their companies. And one of the things they come in with is, they were used to making really great returns on their capital in their own company. But you get in the public markets right now and you say, well, where am I going to go and get cash flow? They're having a hard time with that right now. So those are the concerns we see. There's as these people get older, their fears pop up worse, I would say, because they are older, and a lot of them don't have time to go back and do something. But they've been, to a degree, spoiled the last 10 years, and so a lot of them are very, very complacent, but they're getting away from that a little bit right now. So that's what we see the most of, if you want to know the most concerns.
Yeah, makes sense. Is gold, perhaps even silver, starting to get more and more on the radar of your clients or investors?
Well, we own, out of the 3 strategies, we own gold and the miners in 2 strategies. So obviously we've been bullish on the gold market. We own energy as well, by the way, but we cut back on energy a little bit in this last 15 points or so, but of pricing, but we still own it. And gold, we never changed anything after we actually added to it over the last 2 or 3 months. But gold is a factor for us in that. And I think, it's interesting, Patrick, if you look at it, I was thinking about that this morning early. I was thinking, if I were in Ukraine today and I'm wanting to leave the country, I'm going to take my clothing and whatever. If I have gold, I can take it with me, okay? But if I have one of those 9,000 coins out there, cryptos, that's not going to help me at all. And so you're kind of getting a picture of why gold means something in the real world. Forget about all the other dreams they've had here. But in the real world, that's why it means something.
Yeah, that's a great point, Ted, because it's not just what you might think of an asset, what the value of an asset is. It has to be also the person that you're going to sell it to. They have to see that asset in the same way. With cryptos, we may not be there, but gold and silver, they've been known as money all throughout history.
That's true, and I think what's happened with, and I'm actually surprised that authorities have let this be, though. But when you look at 10,000 cryptos, for example, they were all just dreamed up, with the exception maybe 4 or 5, and they're all. If you go look at the charts on them, I did this past Friday. Look at the charts on all of them, and the minimums are down 40 to 50%, but many of them are down 80, 90. So, and you're not hearing, you used to hear, all, this huddling and different people on Twitter, and they were screaming about, this one and that one or whatever. We always felt like it was a semi-Ponzi scheme, but still what we're seeing is they've been decimated since November, and nobody says much about it, but, that's where we are.
That's true. Ted, as more and more things unfold and we see the reactions to the Fed's taper policies, interest rate policies, the conflicts that are going on in the world, should these things continue, do you perhaps see the two metals, gold and silver, looking to reach all-time highs?
Well, I think they would. One of the problems, I think silver is a little bit more, it's more sensitive to the economy, Patrick, so it's not where we sort of hang our head on it. But if I were looking at the metals going forward, and I've interviewed some really interesting people in that area, but it'd have to be gold number one, and probably maybe copper. The problem about if you look at Russia, they sell a lot of palladium and some of the high-end metals. So I don't know where that puts the markets, but it probably puts them higher. But I think people should own some gold and miners, both. I think they should have both in there because that's a really undervalued group right now, price to cash flow in those companies.
That's another great point. I think Russia does produce a lot of nickel, stainless steel is even for the batteries in electric vehicles, and they also do produce palladium. As mentioned, I think palladium went up some $200 today, and I think nickel went up some 800 as well today.
Yeah.
So we are definitely seeing that. And having said that, overall, and not asking for a financial advice here, but overall, what would be the one or two things you would say to investors, especially in these times?
Well, the first thing is I would say, and we've said this now for 2 years, and they can say, well, you've been early and that sort of thing, but I'd rather be early than late, honestly. But the first thing I would say is you need some sort of insurance liquidity buffer, all right? You can't. The problem about most investors is stay fully in all the time, and this is usually smaller investors where they're really trying to make that money work for them. The problem with it is when you get these downturns, and let's say this market here turns into a true bear market that turns into maybe even a crash. The problem with them being fully in is when you get to a point where they can't take it anymore. Okay, they don't have anything to fall back on, so they pull the trigger and get out at the very, very worst time. And we've said it all along, but your ticket for being in the stock market is to be able to accept volatility. That's your ticket. If you can't do that, then you shouldn't be in the stock market. And that's okay if you're not in it. But I think people right now, a lot of people they're very complacent, and they've gotten really strung out the last 10 years, and they don't have a cash buffer. That'd be the first thing. Second thing would be, have some sort of balance. You can have, if you look at it today, for example, the big NASDAQ stocks, which we own some of, we own a lot of cash too, but, they're under pressure. But if you look on the other side, we have a lot of things that pay cash flow that are not under pressure. Really high quality preferred stocks, convertible preferreds, convertible bonds, things that you could really get a nice piece of cash flow, gold miners. There's so many things you can own that will give you a balance, really. And if there's one thing I think you need today, Patrick, is you need some balance. And the number one reason is so that if you get one of these really deep downs, you have some emotional ability to be able to say, you know what, I'm okay because I have this over here that's liquid. I'm all right. I'm okay with that. Okay, because the investment business is living to play another day. You have to survive, and I think what hurts a lot of people is they go all one way or the other. They're too conservative sometimes. They don't do anything, and so you have to have a balance. And I think that's what people need to keep in mind.
Yeah, that's another great point. I think, through these decades of easy money, can't lose, perhaps a lot of people have come a bit complacent. And I think, now they tend to be perhaps over emotional, jump out of the markets at the wrong time, jump in at the wrong time.
Well, you're going to see, I think you're going to really get a good look. It'll be interesting to see, first of all, if we get margin calls. I think we probably had some on the day yesterday. But I bet we really get some today, and that's one thing, because I've noticed margin debt coming off. But secondly, it'll be interesting to see how people react, because again, I think people have been to a degree spoiled because they haven't had to worry about a true bear market. I mean, if you look at 2018 was 57 days, and 2020 was 5 weeks. That's all you had to put up with, But give me a year or 2 years of a bear market, or even a market that goes nowhere for 5 years, and you'll have a different mindset with people. And I think that's probably, and you have to remember, real estate will probably correct, and that catches more almost than the stock market. So we'll see.
Yeah, that's going to be a rough one. A lot of $1 million homes out there. Ted Oakley from Oxbow Advisors. Before we wrap up, can you let our viewers know how they can follow you and contact you?
Well, Patrick, thank you, and thank you for having us. But they could come to oxbowadvisors.com, and I would tell you we've written, we write a lot of books that are easy to read. You read them in 3 hours or so, but we certainly will. If an investor has an interest, we'll send one of those to them, and we really look at the landscape. So it's oxbowadvisors.com, and love to have you visit us.
All right. Ted Oakley, we thank you for your time, and I hope we can do this again real soon.